Hello, this is Matthew Copley with Copley Financial Group, and today we're going to do a market update. It's been a little while since we've done a market update, and the markets have been pretty volatile. We've seen some pretty big moves in January, a lot more down than up. The markets obviously have come off of their highs. So just a quick update today on what's going on and what we're looking at and what to expect. So what's happening is a lot of the momentum stocks, these are the companies that have kind of taken off in the last few years, are really under a lot of pressure. And this is typical in an environment where inflation is going up. The market discounts future earnings. They want to know that you're making money right now. And they want to be in those stocks that are making money right now, the value stocks. So we're seeing a rotation from the growth area to the value area, which we predicted. One of the reasons our accounts are doing a lot better is that we have made that switch over to the value sectors. However, there's some headwinds, and I want you to understand that we're looking at two things that are kind of working against each other, pulling the markets in different directions. We have a lot of recession indicators. We're seeing unemployment numbers come in a lot worse than expectations. So a lot more layoffs, a lot more problems with employment. At the same time, we're seeing factory orders drop. We're seeing a lot of problems coming out of China. A lot of the data in China, they're not making as much stuff. Well, if China's not making as much stuff, we buy a lot of stuff from them. There's a good chance we're not ordering as much stuff. And of course, this is going to have an impact on the GDP. And so there's a lot of recession indicators, and the valuations in the stock market is pretty high, and it's not a good combination to have high valuations and potential recession indicators coming up. So we're trying to be conservative and hedge, and we've done that with a lot of the buffered index, the annuity accounts, the different things that we're doing to kind of protect against a market drop, a major event. And so we've got those in place. But on the flip side of this, and this is very important because in the long run, this is the part that's permanent. The market coming down, recession indicators, the economy getting soft, that's all temporary. We know that in the future there's going to be all kinds of new technology, whether it's 5G or driverless cars or whatever it is, it's going to drive the markets up. So we know that a recession is temporary. But what's not temporary is the flip side. That's the inflation. And we have a real problem. The government has created a lot of money out of thin air. The M2 money supply has just gone wild in the last couple of years since COVID. And we're seeing the impact of so much more money in circulation and really a lot less goods and services. So you have less things being produced and more money chasing the same goods, and what do we get? We get shortages, we get rising prices, and we've been talking about this for a long time. So this environment where you have a recession, you have a bad economy, and at the same time you have all this inflation, this environment, the last time, and we heard this in the 1970s, it was called stagflation. And so the question is how much stagnation and how much inflation, and this is what we're kind of monitoring. I need you to understand there's $4.5 trillion sitting in bank accounts right now, checking, savings, CDs, money that's just sitting there. And when people realize it's a really bad idea to have money sitting earning 0.5% when the official inflation rate is 7%, the real inflation rate's over 10%. Once that money gets deployed, you're going to see big increases in assets that money goes into. And the people in the bank, they're not going to buy Bitcoin. They're not going to buy Tesla. Those holdings are really going to come down. What they're going to buy is high quality, blue chip value stocks. They're going to buy precious metals. They're going to buy tangible assets. We want to be in agriculture. We want to be in energy. We want to be in those areas that have good valuations. So that's our theme. And I think that we're going to be proven right, especially in the precious metals position, which has not performed well. It is going to take off once the market realizes inflation is a lot worse than they were expecting, and all these recession indicators start to bear fruit, and the government reacts to it, which is going to be more inflation and more stimulus. So we're looking for areas that we think that that cash is going to go. One area that we recently identified that we think is really fantastic is international value. And we've actually found a fund that's in the same family of funds on another one that we like, that's done very well, that bases everything on free cash flow analysis. And so this is a fund that analyzes international value companies looking for free cash flow. And I think this is a great check, because one of the concerns we have with investing internationally is the fact that you don't have U.S. government accounting standards. And so we want to make sure that those companies are reporting accurate numbers. And one way to do that, a check, is on the free cash flow analysis, because it's pretty hard to cook the books on cash going into bank accounts. And so I think it's a great way to do it. So you're going to see some rotation with our accounts into the international value space. There's going to be some more holdings there. You'll get some notices in a lot of accounts across the board. We're looking to move into those positions if possible. Obviously, the bigger the accounts, we're going to have some more flexibility. Some of the smaller accounts, it may be difficult to move too much around. But definitely look out for that in your accounts. One last thing I want to mention is something personally for our firm. TD Ameritrade, it looks like, is finally moving to integrate with Charles Schwab. We're seeing a lot of stuff on the back end, and I do believe over the next year you're going to see some integration between TD Ameritrade and Charles Schwab. I do believe at some point, maybe it's a year from now, you'll start getting your investment statements that used to be TD Ameritrade are now going to become Charles Schwab. Again, I think we're about a year out from that. But one of the challenges that we see on the integrations like this is there's going to be some hiccups, there's going to be some problems along the way with integrating software and different things. So over the next year, I expect problems to develop. We're going to do our best to identify these and look for areas that we can fix. But if anything comes up on your end, please reach out to us. Let us know if you're seeing any problems with the integration. I do expect there to be hiccups along the way. So anyhow, I hope that's a good market update. And feel free to call the office if you have any questions about your accounts or anything specific we're doing. And I hope that gives you a little peace of mind on what's going on in the economy, and we're watching what's going on and making adjustments accordingly.